To the casual observer, the multi-billion-dollar matrix of digital entertainment looks like a thriving paradise of artistic expression and consumer joy. But when you strip away the flashy trailers and hyperactive marketing hype, you find a cutthroat corporate meat grinder fueled by predatory capital reallocation and desperate executive panic. We are dissecting the video game industry collapse from a perspective of raw, unadulterated capital flows rather than emotional fanboy loyalty, exposing how corporate indifference at scale is perfectly engineered to prioritize short-term investor equity over basic product utility. Look no further than the absolute unmitigated disaster that is Ubisoft, a legacy giant that has essentially functioned as a case study in executive delusion, recently reporting an eye-watering operating loss of nearly $1.4 billion for the fiscal year ending in March 2026. Instead of pivoting to a sustainable production model, their executive suite issued a public warning to shareholders that sales would continue to tank by another 8 to 9% over the next 2 years. Yet, their proposed coping mechanism is to double down on live service multiplayer online games to keep players trapped in a cycle of continuous recurring spending. This is the financial equivalent of trying to put out a house fire with aviation fuel. As the modern live service market has evolved into an absolute graveyard of oversaturation, where dozens of identical corporate clones fight over a finite pool of consumer attention. When a company of this scale suffers a structural balance sheet crisis, it completely destroys their short-term credit facilities, locking them into a desperate spiral where they must chase short-term microtransaction extraction models just to service with a remake of Assassin's Creed 4 Black Flag, hoping that weaponized consumer nostalgia can somehow plug a billion-dollar hole in their balance sheet before institutional investors launch an open boardroom mutiny. This reliance on recycling decade-old intellectual property is not a sign of creative passion. It is a clinical manifestation of extreme creative bankruptcy, proving that legacy publishers are no longer functioning as art houses, but as risk mitigation algorithms designed to protect depreciating corporate assets. Previews for the remake might yield temporary positive public relations coverage, but a single nostalgic asset cannot realistically reverse structural hemorrhaging of this magnitude. This systemic fragility brings us directly to the most dangerous single point of failure in the entire modern entertainment economy, Take-Two Interactive and the myth of Grand Theft Auto 6. Take-Two is currently operating less like a traditional game publisher and more like an existential hedge fund disguised as an entertainment company, pinning the absolute survival of its entire corporate structure on a single release date, locked in for November 19, 2026. The financial markets are so tightly wound around this single digital asset that a mere whisper of a delay on an anonymous image board causes institutional shareholders to hyperventilate and dump stock, wiping out hundreds of millions in equity valuation in a single afternoon. The chief executive officer, Strauss Zelnick, had to publicly assure Wall Street that their massive marketing engine will finally ramp up this summer, proving that the modern blockbuster release schedule does not march to the beat of human culture. It dictates the financial calendar because corporations have become entirely dependent on hyper-monopolized consumer attention to service their massive capital expenditures. This hyper-concentration of financial risk means that if a single game fails to satisfy the impossible expectations of the market, it can trigger a domino effect that destabilizes entire distribution pipelines, shaking the confidence of the venture capitalists who fund the next generation of software development. Meanwhile, the actual pioneers of the live service grift are officially turning off the lights, as Bungie announces that Destiny 2 will drop its final structural content update on June 9th after a brutal 9-year journey. Following a catastrophic cycle of corporate cannibalism, mass layoffs, and severe internal dysfunction under the corporate thumb of Sony, the grand experiment of keeping players trapped on a digital hamster wheel is coming to a grinding halt. Executives love to hide behind vague corporate poetry about incubating new games and transitioning to a new beginning, which is nothing more than sanitized executive code for liquidating assets and abandoning a loyal player base that spent a decade funding their digital infrastructure. This collapse of first-mover advantage reveals a hard economic ceiling. Consumers possess a finite amount of time and disposable income, meaning that a market model predicated on infinite attention growth is mathematically impossible in a closed economic ecosystem. It exposes the absolute failure of Sony's broader $3.6 billion acquisition strategy, leaving projects like Marathon stranded in a state of high operational uncertainty. This brings us to Sony's upcoming State of Play presentation, an hour-long corporate commercial that they are actually selling physical movie theater tickets for through Alamo Drafthouse. Because when you own the distribution pipelines, you can force consumers to pay for the privilege of watching you advertise to them. Sony technically owns Alamo Drafthouse, allowing them to construct an insulated ecosystem where the line between consumer marketing and physical hospitality is permanently blurred. Sony is caught in a desperate structural paradox, trying to force compliance through highly speculative, high-friction live service gambles like Fair Games and Horizon Online, while desperately leaning on legacy prestige titles like Wolverine and Naughty Dog's mysterious projects to maintain their fading cultural relevance. The financial friction here is immense, as the astronomical cost of producing first-party cinematic blockbusters can no longer be recouped by traditional retail sales alone, forcing platform holders to explore bizarre, vertically integrated attention plays just to maintain their institutional margins. Even Sega is playing the same desperate game, teasing a Crazy Taxi revival because original intellectual property has become an unacceptable financial risk vector for venture capital, leaving legacy publishers with no choice but to continuously harvest the radioactive corpses of 1990s arcade games. This structural desperation is perfectly mirrored in the indie sector, where independent creators are forced to navigate a landscape dominated by platform gatekeepers who extract a brutal 30% tax on every single digital transaction. We see this play out as Warhorse Studios attempts a high-stakes pivot, announcing a massive Middle-earth open-world role-playing game alongside their existing historical simulation pipeline, demonstrating that even highly respected independent developers must eventually bend the knee to the mass-market appeal of established fantasy intellectual properties just to guarantee financial break-even. But the most profound structural crisis in modern development was recently brought to light by legendary game designer Clint Hawking, who exposed how hyper-realistic rendering technologies like diffuse ambient occlusion and ray tracing are actively destroying the readability of video game environments. In the frantic, multi-million-dollar pursuit of cinematic realism, modern studios have accidentally engineered environments where players can no longer distinguish light from shadow or safety from danger, completely breaking the core feedback loops of game design. When you look at old-school stealth masterpieces like Splinter Cell or Thief, the baked lighting was deliberately clean, highly readable, and perfectly communicated the boundaries of safe exploration to the user. Modern technology has replaced this functional brilliance with flat, muddy night cycles that encourage psychological fatigue rather than tactical problem-solving. This is a brilliant metaphor for the broader industry. By prioritizing superficial aesthetic complexity over core mechanical utility, development budgets have ballooned exponentially to $300 million per title, requiring every single release to sell 10 million copies just to achieve financial break-even. This insane capital requirement completely chokes out creative risk-taking, forcing developers into the exact same homogenized, live-service slot machines that are currently bankrupted by companies like Ubisoft. Look at the current retail landscape where Bubsy 4D drops as a nihilistic meme product on Steam with a handful of positive reviews, serving as a bleak commentary on consumer low-effort consumption. Meanwhile, Forza Horizon 6 functions as an incremental machine to extract capital through beautiful scenery loops in Japan, relying on mechanical asset recycling to protect its institutional margins. Legendary creators like Warren Spector are forced to launch multiplayer heist titles like Thick as Thieves for a mere $5 just to get an algorithmic foot in the door of digital storefronts, relying on the same architectural frameworks that built Deus Ex and Thief just to capture baseline discovery signals. Even the brilliant minds behind Disco Elysium's spiritual successor, Zero Parades, are forced to operate under the shadow of catastrophic studio drama, legal standoffs, and corporate asset stripping, proving that raw artistic brilliance will always be subverted, weaponized, or crushed by corporate risk mitigation algorithms that treat human creativity as a fundamental financial liability. Nintendo patrons are funneled into safe, low-variance products like Yoshi and the Mysterious Book, while platform blockbusters like LEGO Batman Legacy of the Dark Knight function as simplified Arkham-like clones engineered to monetize intellectual property licenses across infant demographics rather than expanding mechanical boundaries. The modern entertainment market is not an artistic community. It is a hyper-optimized casino where the house edge is rapidly shrinking, and the players are slowly realizing they are the ones being monetized through psychological pricing, dark design patterns, and predatory distribution funnels. The video game dream will survive this corporate contraction, but it will be built on the ruins of over-leveraged giants who forgot that you cannot run an empire entirely on false promises, infinite attention, extraction, and systemic financial debt. We break down how power and money work, so subscribe to Wealth Decoded for more strategic mechanics. Let me know in the comments if you are still buying into the live service delusion, and I will see you in the next analysis.